From the morning reading, energy financials lead the SPX higher. eBay sinks on a weak outlook. 7 of 10 sectors moved higher on Wednesday. XLE, XLF, and XLB were the strongest sectors, while XLP was the weakest sector. Oil futures rose 57 cents to close at 51.67. Breadth weakened compared to the prior session slightly as advancers led 2132 to 908 on the New York Stock Exchange and led 1634 to 1093 on the Nasdaq. On the S&P 500 snapshot, a modest midweek advance. The S&P 500 spent the early trade in an apparent indecision following the pre-market release of upbeat residential building permits but downbeat starts, hitting its negative 0.07% intraday low about 30 minutes into the session. The index then rallied to a relatively narrow trading range from mid-morning to its 0.22% closing gain, about half off its 0.41% intraday high around 2 p.m., which coincided with the reasonably sound Fed Beige Book update. The yield on the 10-year note closed at 1.76%, up 1 basis point from the previous close. The election, of course, is almost here. Looking at other U.S. presidential elections since 1950, stocks have seen some weakness prior to the election itself and diverged wildly after the results were in. Among the major sectors, tech and financials usually saw the best gains after the elections, but again, there was wide variability. Same with the other major markets. Gold futures speculators are at odds with the ETF traders. At least that's what it seems like from the last couple of weeks. Speculators have reduced their long positions in gold by more than 20%. At the same time, gold ETF holdings have actually increased. There isn't much history to go off, but we could make an iffy conclusion that the ETF traders are likely to be the smart money. Crude oil has finally hit a new high. For the first time in 778 trading days, crude oil closed at a one-year high that could vary depending on data vendors. When oil took longer than a year to exceed its prior one-year high, it has tended to suffer some mean reversion in the short term, but mostly saw gains longer term. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:07 a.m. Mountain Time, and I am recording this in preparation for the market day of October the 20th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. At the time of this cut, all four of the broad-based U.S. indices were just up above scratch. Crude oil is down about 1.64%. The euro is up just above scratch, as are bonds. And gold is also up just above scratch. In overseas action, China's right at scratch. Hong Kong's down about 1/3%. Japan's up about 1.4%. Germany's up just under 1/4%. And United Kingdom is rotating right around scratch. In terms of macroeconomic reports for today, of note for the United States, you have Philly Fed Manufacturing Index, the weekly unemployment claims, and that looks to be about it. Looking forward to tomorrow, I don't see anything on the U.S. report of significance. In terms of current volatility conditions, short-term VIX 11.97, so that has fallen some in recent days. Skew benign at less than 125. IV percentiles in all four U.S. broad-based indices are still below the lower third of the annual range, with the S&P at a 25, the Russell at a 25, the Nasdaq at a 22, and the Dow at a 25. We've now gone 6 trading sessions without a standard deviation move on any of the broad-based U.S. indices on a close-to-close basis. So relatively been quiet here of late. Let's go ahead and pop over to the charts. So on our S&P 500 futures chart, you can see we've had this very, very neutral range-bound consolidation pattern, somewhat complex pattern at this point, and the most recent short-term action has been this bounce off the lower area of important support. The bulls came in just when they needed to and have had some energy to move back up within the range, but still in relative terms we're just about halfway between the top and the lower edge of this recent range, and we're about as finely balanced as you can be. In terms of the Dow, it is very much the same, almost an identical chart pattern. The NASDAQ, of course, is and continues to be the most bullish of the four indices, and a lot of this has been on the weight of Apple. Remember, Apple is probably some 500 or 600 times larger than the smallest component in the S&P 500. Now, this is looking at the NASDAQ, but it's also a very heavy weight component, and Apple has been benefiting from the Samsung woes. And so if we were to take Apple out of this equation, I suspect that we would see a little bit different pattern in the recent action for NASDAQ, but it is not alone. There are others in the heavyweight category in the tech sector that have also been doing well. But ultimately, right now, it looks like a bit of a bull flag pattern, a bit of a break in that pattern, but it is not yet taken off that breakout with a whole lot of energy, but it is still mildly bullish. In the Russell, we are again finally balanced. This one had been more bullish than the S&P and the Dow, but has broken down into the lower part of the range and then bounced off that as well. It is well within the cloud here, and in relative terms is in the lower third of the range of recent activity. So not a lot to get excited about at this point. We perhaps are still going to be caught in the doldrums for another week or so until the election results start to become better understood. And then, of course, the ultimate election, which it may take in this case, while the bookies, as I understand it, have it about 89% on a Hillary win at this point. Obviously, there are very important down ticket races with the control of the Senate and the control of the House theoretically in question. So if one of those were to change, that would certainly have an impact on the overall market and how the market would respond to that change in or shift in power base between the two major parties. So something to consider as to why we might be in this kind of pronounced, prolonged doldrum across the broad markets, because it's not so much uncertainty about the presidential race as it might be uncertainty about the House and the Senate. In terms of some of the other markets, crude oil, you've heard, put in a new intraday 52-week high, and you see it closed right at that level. And then so far today has given some of that back. In fact, right now, you'd have to say that that was a false breakout, and we have a bearish, I suppose, of course, this day's still going, but right now it would seem to be something of a bearish harami coming back into this price action, so kind of rejecting that new all-time high. One of the morning authors did mention that you could often see profit taking on such a move, and that would seem to be, at least in the very short term, what has happened. Now, once this has been penetrated, certainly it could be penetrated again more easily, and while we had this recent action of a breakthrough this swing high, a back up to the prior high, consolidation, then a break, I suspect that we will go back through this area, and it's just really a matter of time. And we could very well visit the, as much as $60 a gallon here in the future. Now, the timing on that is a bit uncertain for sure, but that might be, the extended long-term move could be something towards that target. In terms of gold, gold, of course, has been on something of a bounce in the recent days. We'll see if it can recover. It's gotten a lot of overhead resistance at this point, and this breakdown was a serious breakdown. It has had something of a rounding bottom pattern that has now seemingly started to recover a bit. So we'll see if we can actually get, in order to get a higher high, we've got a long way to go and got to get through a lot of resistance. Otherwise, this could very well set up into a bear flag and then fall even further. In terms of bonds, bonds also seemingly has recovered off a little bit of a swing bounce, but clearly the pattern at this point in the intermediate term is for lower highs and lower lows and a whole series of those. So bonds seem to be starting to set up for a longer term bearish pattern. Again, that's long bonds. And then volatility, let's finish with volatility. Volatility has been falling in recent sessions. The entire last week has seen fallen volatility. We're currently below 15 and really are flirting with going below 14. So this is normally the land of bulls, and when you have volatility between a 12 and a 15, and that's where we are right now. So part of this may be a slightly bullish short-term cast. Certainly, you have to say there's not a lot of fear in the market right now. Anticipation of the elections and other energy providing impetus, is out there, but is generally not thought to be extremely scary for the market. That has certainly not been priced in into the short to intermediate term volatility indexes. I think that's probably enough on the charts. Let's go ahead and go to the daily report. And a couple things here. First of all, the intermediate term phase opinion still continues to be a very weak market. Phase 5, a break of diagonal support. Now, it has to be said that this has been somewhat of an asterisk to it, in that when we went and had an opportunity to break horizontal support did hold. So a point to the bulls there, and an overall kind of losing contest, as it were, right now, as we are market phase 5, and the bears are primarily in control. It's kind of like having the football and being on the 10-yard line when you're down by 4 scores. So overall bearish cast there. In terms of our 3 market timing signals, generally pretty ugly here, but certainly can be uglier. The first signal comes from IBD and is uptrend under pressure. Certainly that is a warning sign. The second signal coming from the GMI index, a 2 out of 6, and the more sensitive GMI2, a 7 out of 8. So a bit of improvement on the GMI2, but overall a sell signal, which has been in place since 10/12. The third market timing signal from Stock Charts Decision Point Scoreboard, you see, is pretty ugly as well. S&P 500, 100, and Dow all in the neutral to bearish cast for the short to intermediate term, and all up against a long-term mixed signal. So not very good. NASDAQ, of course, has been faring somewhat better, but you notice the short term here also neutral to bearish. Intermediate term holding up a bit better, and this again is largely being dominated by the Apple Samsung situation. In terms of position sizing opinions, the first model, the portfolio investor position sizing opinion right now, long side is at 50%. Volatility active trader based model is at 75%. Intermediate term market posture has been very mixed in the last week. We have flipped back over, and now for a second session, into a very weak bull. And back to that analogy of the football, the bulls have the ball, but they're way back and sitting about, first and 10 from like the 10-yard line, and perhaps are even several scores down to the bears. So this is bullish. The bulls have the ball, as it were, with a very weak intermediate term market posture that has been joined by the Dow And the NASDAQ also first day has flipped over and is above a 50, so that's actually characterized as a strong bull after very briefly going to a strong bear standing. So this has been flip-flopping back and forth, and you get these kinds of flip-flops when you have a market that is very finely balanced. The indicators kind of wrap around themselves and give signals to both sides with a lot of changes, and I think that's probably mostly what we're seeing right now. Also keep in context that we have a weak bearish sentiment line. This is a longer term indicator and would generally tell us that to expect that the bearish moves would be longer, deeper than the bullish moves. So we got kind of contrary signs going here with this very weak bull against a longer term weak bearish sentiment line. Overall hedge warning status retains level 2, and this is basically red light. Overall conditions are not terribly good to initiate new positions, especially for novice traders. If you look at the 3 specific opinions, option income strategies, overall conditions, borderline acceptable for novice traders to initiate new positions. And then covered calls and put selling, generally thought to be not acceptable to initiate new positions for novice traders. More aggressive traders should be considering a very, very defensive structures, such as a 2-to-1 ratio of in-the-money, out-of-the-money strikes, a 2-to-1 ratio of low beta versus high beta positions, and then also perhaps legging into that cover call through the use of selling puts. If you sell puts, consider spreads. Also, be sure that you position size and the scale that you're willing to own. This is not a market that has rewarded aggressive play in recent weeks. In terms of specific warnings, you have a high distribution day count on the S&P, though this has been improving. The count is now down to 6, and below 5 that would fall out of warning status. VIX phase was increasing. I suppose we probably should call this neutral at this point. Under the trend-based area, we still have this weak market phase 5. We still have a very, very weak bull at this point. Also, more importantly, perhaps, the key intermarket risk aversion indicators, all 5, are now flagged as risk off. In terms of sentiment, relatively benign on stocks, bonds, and gold. You see the fear and greed index now at 39, so still down in the fear area, and frankly a repeat of the previous close at a 39. So we've been kind of this neutral to slightly onto the fear side for a number of sessions now. In terms of sector specific, you can see that for the most part we were pretty good breadth across the various sectors to the positive side with yesterday's action. Most of the negative coming from healthcare, consumer staples, and utilities. So mostly defensive oriented. If we look at our stubs, as it were, consumer staples, negative. The treasuries certainly have been bouncing lately, but are relatively negative. Utilities, negative. And then telecom actually squeaked out a barely positive day, but had all 5 components going positive yesterday. So still relatively mixed for the defensive sectors. Mostly it was a risk-on day yesterday with the higher beta sectors and industry groups performing better. In terms of market postures, you can see quite a bit of improvement here from the prior session, while still significant amount of red here. We are starting to see some improvement. Yesterday was pretty much all red on the short to intermediate term across all the sectors. Again, a reminder that these indicators have been in this finely balanced market pretty much wrapped around one another. So we've been getting lots of signals back and forth. One day everything looks green, and then 2 days later everything looks red. We've not had any kind of trending going on in any of these sectors to speak of that really holds up much analysis. In terms of percent change, you see the changes here yesterday, mostly green, and that's helped with the 5-day and even into the 1-month time frame. Overall, probably healthcare and utilities and consumer staples being the worst performers of late. So something to kind of keep in mind as you're working through your watch list. So I think that's probably enough for today. We're right at 20 minutes. So I'm going to scroll through. If you see something of interest, just hit the pause button, go to that hyperlink, and get the additional information. And then we'll go to the disclaimers. As always, hit the pause button if you need more time to review the disclaimers. Also note the full set of disclosures can be found at the hyperlink down here at the bottom of the slide. As always, we should be back here tomorrow for the next market preview from Falcon Global. Manage that risk, and you should see that everything else falls into place. And in the meantime, be sure that you go out there and seek to learn something, and good trading.